This is part of a series of talks on the finance topic in business studies, and I'm going to talk initially about the strategic role of financial management. In this particular course, anytime you see the word strategic, you're really talking about the top management who are making the decisions. With regard to finance, we're talking about how the business funds itself, the combination of debt and equity that it uses, the way it keeps its financial records, and ultimately how it performs. As we often hear in this course, marketing, operations, HR and finance are interrelated, and so it's the financial aspect of the business that provides the ongoing strategic direction for the firm, but in association with the other managers of the different functions. One of the things we establish from the beginning in finance is that any business will have particular financial objectives. The ones we look at in this course are profitability, growth, efficiency, liquidity and solvency. Liquidity and solvency in combination are looking at the short-term and long-term ability of the business to pay its debts as they fall due. The first financial objective we look at is profitability. Clearly put, profitability is the business's return. So we look at return to business in terms of profit in several areas. So if we look at the revenue statement, it's the difference between the sales of the business deducting the COGS. That gives us the business's gross profit. Now look, if the business had no other expenses, gross profit would be the same as net profit. But what we know is that in addition to the cost of goods sold, the business also has to add up, calculate its total expenses, which may include things like wages, rent and the like. And this number, this total expenses, is taken away from the gross profit figure, and that gives us net profit. Students often ask in this course, well, what about tax? Well, what we know in reality is all businesses pay tax, and their particular tax regime depends on their particular financial circumstances. But roughly speaking, once a business has made its net profit, corporate tax rate is 30%. So 30% of what is made net will be taken away. Now, what is left over is net profit after tax, and that's what we commonly call the earnings of the business. Depending on the size and the legal structure of the business, those particular earnings can be distributed to could be the sole trader, partners, or ultimately on the corporate side to the shareholders. Just a very rough rule of thumb in Australia, we often talk about 50% of any profits being distributed as dividends and 50% being retained. Now, that's not every business, but it's a general guide. The reason why businesses retain some profits is to enable it to fund future growth. But the reason why it rewards dividends to shareholders and owners is that's their reward for the risk taking involved in being an entrepreneur or an owner of a business. Firms need to get a fine balance between trying to retain profit and rewarding shareholders. In Australia, it's illegal for a business that's making a loss actually to pay dividends. So, for instance, the business couldn't go and borrow money to reward the shareholders. The next objective of financial management is one called growth. Now, this particular objective can be looked at in several ways. It could be looked at in terms of sales growth. It could be looked at in terms of market share. This particular objective, there's not a ratio to go with it, whereas the other four there are. The third financial objective is efficiency. This is basically the way the business uses its assets, how efficiently it uses its assets, and later in the course we look at this efficiency idea through several different ratios, return on The efficiency ratio is one example of testing efficiency. That's the expenses. And another example would be the accounts receivable turnover ratio of how many days your creditors, debtors are taking to pay the business. Usually a credit period is 30 days, but for instance, they may be taking 38 or 40 odd days. Now, the closer to your credit period that they're taking, say 30 days, that's a sign that the business is efficient. Now, if you're not collecting your debts for 60 or 70 days, it's a sign of inefficiency. The next ratio we talk about is the liquidity ratio. Now, if we look at the balance sheet, we look at the top of the balance sheet, we look at current assets, and we look at current liabilities. It's the ratio of current assets to current liabilities. That's how we see how liquid we are. As a general rule of thumb, with this particular ratio on liquidity, we're looking for $2 of current assets to cover $1 of current liabilities. Liquidity itself is the ability of the business to pay what's due in the short term. There is a further ratio called the acid test ratio, which takes away stock, and basically that's a test is if things went wrong, how easily could a business meet its short-term commitments. So liquidity tends to relate to short-term, and because of that, in the balance sheet we can't include anything that's non-current in any calculations we do. The last financial objective we look at is the idea of solvency. When we talk about a business being solvent, we're just saying that it's able to meet its debts as they fall due. If we say a business is insolvent, we're saying that it can't meet its debts as they fall due. Now, solvency tends to look at the longer term, and it takes into account both short and long-term assets and how they can meet any short and long-term liabilities. Probably the best test of a business is solvent or not is to look at the accounting formula: assets equals liabilities plus owner's equity. In truth, if you put your assets as a number against your liabilities as a number, assets should always be more than liabilities. Now, when liabilities become more than assets, it's a sign that the business is not going to be able to meet its problems as they fall due, and that's when businesses often go into cessation through if they're corporate liquidation, or if they're individual businesses, sole traders, into bankruptcy. The next main syllabus heading in the finance topic is influences on financial management. In this part of the syllabus, we look at how a business funds itself, and we talk about two main ways. We talk about internal sources of finance and external sources of finance. So generally speaking, for internal sources of finance, we're talking about the existing owners putting up more money for the business. They may have put up capital originally, and they may be asked to put up more. And another way we look at internal sources of finance is retained profits that the business has earned through earnings in the past. There's been a decision not to distribute those earnings through dividends and profits, but instead retain those profits. And those profits, if you look for them, they're in the owner's equity part of the balance sheet. And so if you decide to retain profits, the net worth of the business actually goes up because you're keeping that money within the business. The next heading we look at is external sources of finance. And the most basic division here will be debt sources and equity sources. If we bear in mind from the beginning that any source of finance you're using probably has to match the need. So what's the problem? If the problem is a short-term problem, we will come up with some sort of short-term solution. If the problem is a longer-term problem, or it's an asset that you need to fund, which is going to last multiple years, the solution is usually one that lasts multiple years. When we speak of debt as such, we've got several sources of short-term debt. Now, the first one is an overdraft. An overdraft is obtained from a bank or building society. An overdraft is in some ways like a short-term loan, but a little bit different. The way it's different is that when you go to establish an overdraft, you're saying to the bank, will you let us use your money because we're short of our own money? With some seasonal businesses, there's particular times here where cash flow is short. It may be a surf business in winter, for instance. A good business in its financial planning will realise the times of the year where it's going to have a bit of a shortfall. And so the business will approach the bank and say, look, between May and July, we're going to have more money going out than coming in. Would it be possible for us to overdraw on our account up to, say, $5,000? And the bank will say yes or no. An overdraft is actually an agreement with the bank. The bank may say, how much do you need? And you may say, well, look, in those months between May and July, we may need up to $5,000. An overdraft, which is a short-term debt source of finance, is one where you do not actually pay interest until you use the facility. So I may establish it in May, but if I don't actually start using it and overdrawing until June, I won't be charged interest. But the thing about an overdraft is, as soon as you establish it, you're charged a fee. So they may charge $100 to set the overdraft up. They say, well, your limit is $5,000. And what the bank basically does is it will honour any checks or payments that you're having in that particular time up to $5,000. Another form of short-term debt finance is a short-term loan. Now, a short-term loan is different from an overdraft in that as soon as you go and establish it, you sign the contract that say to borrow $5,000 for 6 months. It's what's called a fully drawn loan. So as soon as the bank agrees to give you the loan, it gives you the whole $5,000 from day one. And from day one, you are paying interest back on that particular loan. So with an overdraft, you only pay interest as it's getting drawn. With a short-term loan, it's fully drawn from day one and you pay interest from day one. A third form of short-term finance for a business is trade credit. This literally means that your supplier trusts you enough as a business to deliver you stock without you actually paying for it. And what they will usually do is they'll say, we'll give you up to, say, $5,000 of credit, we'll deliver you $5,000 of goods, and we'll give you 30 days to pay. Trade credit's important because you're using the supplier's money. Now, the supplier doesn't give you the trade credit because he loves you. It's usually because competitiveness in the particular industry, a 30-day credit period may be normal. So some suppliers feel if they don't give some customers, trusted customers, time to pay, those customers may go elsewhere. Once you're known enough as a business to receive trade credit, the business should be giving you a copy of their credit policy. It will probably say how many days you've got before you need to pay and what the sanctions it may bring against you if you don't pay. Most businesses actually put a credit limit on most customers, depending on how big the customer is, how established the customer is, and how long it's been a customer of this particular supplier. Quite commonly, if there's a new customer in the market, and that's you, what the supplier will do, it will do a credit check on you as a business. Bear in mind here that the fact that you've had credit before with other people is not a problem. It's actually a good thing. It's when firms don't actually pay is the problem. But if you've had trade credit elsewhere and you've proven a good customer to that supplier and you've paid it back, then your credit rating will be good. Another form of short-term finance is a commercial bill. Now, with a commercial bill, you are issuing an IOU to a supplier promising to pay a certain amount of money back within a certain amount of time. Now, it's a short-term form of finance because these bills have usually got a face value of 30 days, 60 days, or 90 days. The biggest firms like BHP, if they issue a commercial bill, it's done on the strength of their name, the goodwill surrounding their name. Not all businesses are BHP, so what firms sometimes have to do if they issue a commercial bill is they have to get it endorsed by a bank. So that basically means that they promise to pay the supplier in the number of days we've said. If they fail to do that and the bill has got a bank name on it, the supplier will go to the bank to collect their money. One of the beauties of commercial bills, it falls in the short-term money market in terms of a market, and a holder of a short-term bill, like a commercial bill, can actually resell it, so there's a secondary market for these particular bills. A final type of short-term finance is factoring. Now this basically is where I'm a business and I've made some sales. Say I've made 100,000 sales this month, but I'm under pressure for cash. Now, if I made $100,000 worth of sales, often I've had to give credit to a customer to obtain that business. So if I need cash quickly, I could phone the customer up and say, look, I've given you 30 days to pay, but can you pay me sooner? Now, quite often a customer will say, no, sorry, I can't pay you sooner. Now, one alternative that the supplier's got is they can actually go to a financial institution called a factor, a type of finance company, and it can say to the factor, look, I've got these $100,000 worth of sales I've made. I'm going to collect the money for it in 30 days. How much will you give me today for that $100,000 worth of debt that I'll collect in 30 days? Now, what the factor will do, they'll do a credit check on the people you've sold the goods to, and if the credit check is good, they'll calculate an amount of money they'll pay you today, hoping to collect the full amount of $100,000 in 30 days. So, for instance, they may give you $97,000 today, cash, and they'll wait to the end of the month and they'll go and collect the whole amount, $100,000. Now, why is that good for you? Well, it's good short-term finance for you in that you're getting cash up front today. The downside of factoring for a business selling its receipts is that it's accepting $97,000 when, if it waited the whole period, it will get the full $100,000. So if you continually accept $97,000 instead of the $100,000, that's going to affect your profitability in the long term. How does it help in the short term? It improves your liquidity.